For 2019, I think it's important that people get some perspective on what's happened over the course of the last 18 months or so. There's been a period of normalizing US monetary policy, and a period actually, from one perspective, of normalizing valuations on equity markets. So beginning of 2018, volatility was low, valuations high, great degree of confidence in growth, and we were cautious actually, because it almost seemed too good to be true. And we could see the slowdown in 2019 not too far away, and the delayed impact of interest rate increases likely to impact valuations in the second half. And that's kind of what happened. So from here, taking that perspective, that background, what we see is lower valuations, a period of slower growth for the world economy in 2019, but not a recession. US monetary policy on pause, which will give investors support. Very little evidence of financial distress, and very little evidence of inflationary pressures, which would prevent further monetary stimulus should it be necessary. So we've actually moved, despite the volatility, from a cautious position on equities to neutral. So 12 months on from the peak of the market in January 2018, we find ourselves with a different set of risks. There's less confidence about growth, but there's also significantly lower valuations. And that's a more important factor for us. The history suggests that when you do get involved in markets at a lower valuation starting point, it may be obvious, perhaps, but you tend to get over the medium term a better long-run return because many of the risks are already discounted in market prices. So it's the first time we've been able to say for a number of years that valuations are in line, should we say, in aggregate, a little bit expensive still in the US, but below average in the UK, for example, on a price to book basis, and a little below average within the Eurozone on our estimates. And that's a good starting point for us for at least a normal return on equities in 2019. Despite the concerns about growth, profits forecasts for 2019 still call for upper single-digit rates of growth, 9–10% for the UK, Eurozone and US, and a little higher than that in emerging markets. In terms of US monetary policy, there's been a rising degree of concern amongst investors that the US Federal Reserve was going to continue increasing US interest rates almost regardless of what happened in financial markets. We always thought that that wasn't going to be the case. And now it's an interesting point, just as investor sentiment turns on that particular point. The US Fed has recognized that financial conditions have tightened across the world. And Fed Chair Powell actually was explicit in August that in the absence of inflationary pressure, the better course of action would be to run monetary policy a little easier than tighter to avoid prematurely terminating the US economic expansion. And that's exactly what they're doing. And I think by the second half of 2019, we'll find that the bulk of the impact of the tightening of US monetary policy is actually in the rearview mirror. The inflection point is clearly passed. The financial markets are pricing in no US interest rate increases this year. So in the absence of inflationary pressure for equity investors, we still think the Fed has their back.